Good afternoon, my people. What's going on? This is your man, Charles Tank Harris, CEO and founder of the financial planning firm Wealth Our Way. I welcome those of you who are new to the Facebook Live series that I do every day at 12:30 weekdays, and I welcome back those of you who are repeat offenders to coming in and getting this financial literacy knowledge spewed upon you for 15 minutes or more every weekday. We started a series yesterday on all things life insurance. Life insurance is a very, very deep topic because there are many facets, many products, many purposes, many end goals that we can reach through the utilization of life insurance. I talked yesterday about term insurance, and I also talked about how we could calculate someone's insurable need as far as income replacement. Today, I'm going to talk, what is it with me having to sneeze when I start to live? It's going to come back. So anyway, you got to love live recordings. So yesterday I talked about term insurance. Today we're going to talk about whole life insurance. We're also going to talk about something that's a variation of whole life insurance called limited pay life insurance. So buckle up, because there's going to be more information today, because whole life and limited pay, a little bit more complicated. Hey, miss, how are you? I always love that you come through. It makes me smile, as you can see. So it's going to be a little bit more information today than yesterday. Hey, Miss Dawn, how are you? We love it. People are popping up. So we're going to just get into this, because, you know, I start a little bit early now. I've learned to start at 12:28, 12:29, because I've experienced, hey Dawn, I've experienced the experience of my live video telling me that it was unable to start at the last minute. So now I just start talking to myself a minute before 12:30. But now that you guys are here, we're going to start the program. We're going to start talking about whole life and limited pay whole life insurance. So we talked about term being just basically designed to pay a death benefit in the event that the primary insured person passes away. And bringing that up, we should go, as I'm doing these things, these are all unscripted. These are all just informational sessions that I give based on industry experiences that I've had. Sometimes I'll say a word or I'll mention something and I realize you guys may not know in depth what that means, so I should go backwards a little bit and talk about that. For every insurance policy, there are three parties to the policy. There is the owner of the policy. That is the person that has the right to make all of the contractual changes on the policy. Then there is the primary insured. This is the person who gets underwritten, who gets approved for insurance, and whose life is actually the subject of the insurance. And then there is the payer of the insurance policy, the person who writes the premium. Sometimes all three of those are the same person. If I buy a life insurance policy on myself and I pay my premiums, I am the owner, I'm the primary insured, I am the payer. But they do not all have to be the same person. So we could have a company that owns a policy on a key employee, so that's the primary insured, and the owner of the company could make the premium payment. So we could have three different parties. And then the other person that's a party to insurance policies is the beneficiary, but the beneficiary is not considered to be one of the three primary controlling interests in a policy. But beneficiaries do play a very large part because they receive the money. So talking about whole life as opposed to term, you have a peril. A peril is what we call an insurance, an event that triggers the insurance to work. So the peril would be death, and a check gets written to the beneficiary. With whole life, you have an additional feature. Whole life has a component called cash value. Cash value grows over the course of the premium paying period. It also will continue to grow past the premium paying period for limited pay whole life policies, which I'll talk about toward the mid to end part of this lesson. When you have a whole life insurance policy, so we talked about how term can be set for a certain number of years to have a guaranteed premium. Whole life insurance is just what it sounds like. That premium is set to be in place for your whole life. So when you're quoted a premium, you're expected to pay that premium until the day you pass away. There are ways that you can stop paying your premium and keep your insurance in place. That would be through utilizing the cash value in the policy. So how does the cash value inside of a life insurance policy grow? It grows from part of the premium contribution as well as the dividend that is paid by the insurance company. So there are two major types of insurance companies. There are stock insurance companies and there are mutual insurance companies. A stock insurance company is a publicly traded insurance company that has stockholders, shareholders. People own the insurance company. I'll get into why that's important in a second. Mutual insurance companies are owned by the policy owners. So if you are at New York Life, Northwestern Mutual, Guardian, Penn Mutual, hey Renee, if you're at one of these mutual companies, the fact that you own a life insurance policy makes you also an owner of the company. Why is this distinction of any concern of yours? Think about it this way. I'll use an example outside of life insurance. Somebody here drinks Coca-Cola. As a customer of Coca-Cola, you would like Coca-Cola to be as low priced as possible so you can enjoy your Coca-Cola and not pay a lot of money for it. What's up, Big Joe? However, if you own stock in Coca-Cola, you would want Coca-Cola to be priced as high as possible to the point where people would continue to purchase it. You want more revenue. So you have a differing viewpoint of the customer if you are a shareholder. Every company has a board of directors. The board of directors' job is to keep the shareholders happy. So if you're a customer and you know the company is being ran to keep the shareholders happy, you're coming in second. All of the things that we tell each other in business about the customers first, it's not really the design. It's the shareholder that companies are happy to please. Now, you would want to please your customers so they don't leave, but your priority is keeping your shareholders investing in your company. You go back to the example of a mutual company where the shareholder and the customer are the same person. There is no advantage to trying to overprice something because you're getting the benefit of it as the shareholder and the client. So that important part comes into how cash value grows inside your policy. If you're at a stock company, you may have a board of directors when they are voting to declare what the dividend rate is, who are more interested in keeping the share price of the stock higher, and they may vote to put less dividend into the insurance policy. If you're at a mutual company, there's no conflict there. They're going to put the most money that they feel possible that doesn't hurt the company's operations into the policy because they're pleasing both their shareholders and their policy holders. So apples to apples, you normally find that if you're getting a cash value policy, you would like to chase down a mutual insurance company. And there's a long list of mutual insurance companies. The big four, as I said earlier, are Northwestern Mutual, Guardian, Mass Mutual, New York Life. Actually, I didn't say it before, but those are the big four. So highly rated companies. The client themselves, the policyholder, is the shareholder. It's a mutual relationship. Not to say stock companies like AIG or Pacific Life are bad. It's just a different corporate structure. So when you buy this whole life policy, and I'm going to use a monthly premium number of $100, that $100 is broken up to cover the cost of insuring your life for the company, as well as a portion that's going to go into the cash value, i.e. this savings account. And that savings account is going to grow every year by that contribution you made, as well as the dividend that the company is paying. When that pot of money, that cash value, gets high enough, you make an election as an insured, as the owner. I'm sorry, the decisions get made by the owner. You make the decision as the owner as to how you want to receive your dividend every time a dividend gets declared. One way you can do it is literally have the insurance company send you a check. It's called electing the cash dividend. They'll send your check to you. A second way is to do what's called purchasing paid up additions. That's the more complicated way, but for those of you who have some investment experience and you think about reinvesting your money into your mutual fund or into your stock, compounding it, think of paid additions the same way. If I have an insurance policy that pays me a dividend and I elect paid up additions, that dividend is actually buying me a very, 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 very teeny paid up life insurance policy. That's why it's called paid up addition. It never requires another premium. It may be microscopic. I use an example when I show this to people of your main policy being a brick and the paid up addition being a pebble, and stacking a pebble on top of the brick. Why is this important? Because the paid up addition also gets a dividend declared every year, but it's of course proportionate to the size of the pebble. So you will see your dividend growing faster if you elect the paid up addition choice for your dividend. The third choice for your dividend is what's called premium offset. That means that you can say, hey, my premium, I said we're using $100 a month example, so my premium is $1,200 a year. Hey, Melissa, after the year, the dividend gets declared, and let's say the dividend was $103. You could tell the insurance company, hey, put that $103 toward my premiums. So 1 month of premium, I won't have to pay because my premium was $100 a month. I got $103 coming my way. Boom, it offsets the premium. The reality is that as your cash value grows, so insurance is a very front-loaded product as far as the expenses are concerned. So people who sell the insurance, they get paid for selling it. They get a commission. That commission comes out way up in the front. The expenses for running the insurance company, that a lot of that gets loaded all up into the front. So what you'll see when you're paying your insurance premium and you're getting a statement every year, in the first 5 to 8 years, your cash value of your policy is less than the total of the money you put in. And that's fine because you're not buying it to make the money in that frame. You bought it for insurance purposes and you're buying it for a long-term savings vehicle. After a certain point, normally I say it's after 8 years, you catch up. You catch up to the amount of money that you've put in being equal to what's in the policy's cash value. And that is where I say the magic starts to happen, because now your policy's cash value grows every year higher than the premiums you're putting into it, because the dividend is hitting a higher basis of cash. So I'm going to shift for a minute from the whole life concept to limited pay whole life, because when I was at New York Life, we had a product called Custom Whole Life, where we could make a whole life product for you, but design the number of years that you have to pay it, which is great. Now, hope you guys got pen and paper out there and can think about this. If you buy an insurance policy that the premiums are due to be paid for the rest of your life, you're a 40-year-old person, you buy a policy where the premiums are due to age 100, you're expecting to pay for this policy for 60 years. If I come to you and say I have the ability to sell you a policy that has the same death benefit, but you only have to pay for it for 10 years, do you expect that product to cost more or less than the one you're paying for to age 100? Pop quiz, who's going to answer first? Is the premium on the policy that you only have to pay for 10 years more expensive or less expensive than the policy you're going to pay for until age 100? Come on, Big Joe. I know you got this. Putting you on the spot. To you. All right. Nobody wants to. More. My man. Big Joe. That's what's up. Respect. So it's more. Of course it's more. I sell you an insurance policy that's a $250,000 death benefit. I tell you it's $100 a month that you have to pay from now for the rest of your life. Then I come and say, hey, you know, you want that $250,000? What's up, Big Frenchie? You want that $250,000? I can make it so you only have to pay for it for 10 years instead of 60 years. Of course it should be more. So that part of it is easy to understand. Here's the part, though, that gets real magical. Whenever you pay an insurance premium, it's kind of counterintuitive. Whenever you pay an insurance premium, there is a premium tax that gets deducted by the company. So that means every time you pay a premium, some of it goes to an expense, which means that less of it can go to your cash value, less of it's growing in the dividend. Well, when you buy a limited pay product, let's say you buy a 10-year whole life product, you stop paying premiums after year 10. If you're not paying premium, now there's no tax. So the dividend can keep growing and the dividend can keep hitting your account, your cash value can keep growing, and what you end up seeing is cash value grows much faster in limited pay policies than they do in whole life policies. And the two reasons for that are you're not paying any premium taxes moving forward after the limited pay period is over. And the other reason is, which is kind of logical based on us saying that we're paying more faster, you put more cash in. So understand this about a dividend. When companies declare a dividend, what they are declaring isn't the actual dollar they're going to give you. They're declaring their dividend scale. It's a percentage. It's a dividend scale. So the bigger your base inside of your policy, that percentage hits a bigger base, you get more money. So if you've crammed more cash into a policy sooner, you're going to get paid more when your policy is done being premiumed. So now let's talk about taking money out of an insurance policy, because the whole reason for having a whole life or limited pay whole life policy is that savings vehicle. A couple ways we can do it. We can surrender part of our insurance policy. Going back to the example of the brick with the little pebbles on top of it, we have what's called paid up additions. Each paid up addition has a little cash value. We can start surrendering them first and get cash without touching our main policy. That's a non-taxable event. We're surrendering something we've already paid for and that we own. That's why people say the proceeds from insurance are tax-free. I'll get into the one instance when it's not. But you can surrender part of your policy, take that money out tax-free. The other thing that people do when they want to access their insurance policy is they take policy loans. Once again, a loan is not a taxable event. It's borrowing money from yourself. And the interest that you pay goes back into your policy. So the company will charge the interest, but because especially in a mutual environment, you will end up growing your cash value as you pay yourself back. Because now the dividend scale, and I won't get into recognition and direct recognition, it's a somewhat complex way that companies view the money that's borrowed from a policy. We can talk offline about that for anyone who wants to know the difference between direct recognition and non-direct recognition. But going back to taking the money out. So I used to use, when I worked for New York Life, and even before that when I was a business manager, and I would call insurance people to set up policies for my clients. For my professional athlete clients, I loved custom or limited pay whole life insurance. Because I could take an NBA player who just signed a 7-year, $20 million contract, and I can say, hey, let's commit 10% of this to your pension. Your tax-free pension is what I would call it. So the player, 7 years, they may be 23 at the time, they got a contract till they're age 30. All types of retirement stuff is set up for them when they're 45, 50 and beyond. But a lot of players run into trouble from the day they stop playing until they reach that point where their retirement money is set up. I would set these policies up to bridge the gap. I could call a New York Life and say, sell my client a 7-year custom whole life policy because I've put aside $2 million, 10% of their $20 million, and I want the premium to be almost $300,000 a year, 298. I'm not going to do the math, although I'm quick like that. It's probably 294 and some change. But now that premium is being paid every year, 290, 290, 290, 290. At the end of the 7-year period, the client can start taking cash value out of the policy. If they didn't squander their other money, they could take from their investments first. The longer they let that cash sit in the insurance policy before they start touching it, the bigger it's getting. And when they start taking it out, they can take it out tax-free. So I love those types of policies. It's guaranteed to make sure that they don't lose money. And the growth, although you can't guarantee that a company is going to pay dividends, most of the mutual companies have paid dividends for over 150 years nonstop. So I can't guarantee you that the earth's going to spin tomorrow, but it hasn't not spun. So there you go. Now, when we go back to looking at the whole life and the custom whole life proposition, the question becomes, which one should you buy? So I gave you some information. Now let's talk about what's practical. I tell people this when it comes to insurance. Yesterday's lesson was more important than today's lesson because most of my clients that are financial planning clients of mine, they need term insurance. They need to know that if they die before they reach their goals, that their people will not be harmed financially. However, there's a dirty industry statistic. Almost 95%, feel me on this, almost 95% of all term insurance policies that ever get written never pay out. So that's why people say, oh, insurance is a scam. But I want you to think about it. I want you to go back to the example I gave yesterday. 35-year-old guy, parent, husband, father of two, buys a 30-year term insurance policy. A lot of us on this call are already, you see all my gray, I'm already 50. I'm hoping I don't die by 65. Guess what? Most people do not die by 65. So the one reason why term insurance doesn't pay out is because you outlive the term. And that's supposed to happen. You don't buy car insurance to go run your car into a wall. You don't buy homeowner's insurance to set your home ablaze. You don't buy life insurance to hope you die during the period. You buy life insurance in case you die, to help the people who were left behind. That's why term insurance is not very expensive, because companies have what are called actuaries. I studied actuarial science when I was at Temple. These are mathematicians that determine the likelihood that the company is going to have to pay out, and they price it accordingly. So that should be the first giveaway as to why whole life is more expensive than term. Whole life is guaranteed to pay out. If you're paying your premium, the insurance company knows they're writing a check one day. With term, they know they only write a check 5% of the time, so they can afford to price it very cheaply. Another reason term insurance doesn't pay out is people don't continue paying their premium. The average term insurance policy, I believe, these numbers change all the time, I believe the average term insurance policy lapses for lack of premium payment in the middles of year 7 and 8. Why? Well, most people buy insurance for one of two reasons. Somebody died and it scared the hell out of them and they got emotional, or somebody like me called them up and told them to buy it. 7 years from now, neither one of those things is all that pressing. You over the person who died, and the salesperson's not calling you every year to talk to you about the policy that he got paid on once 7 years ago. So now you're sitting there like, I'm paying this $48 a month, and I'd rather put it toward my cell phone bill. F this insurance policy. And that's what people do. And they let their insurance lapse. So that is another reason. Thanks, Big Joe. That's another reason why most term policies never pay out. People let them lapse. The other reason is, so you have the fact that people outlive the term. You have the fact that people do not continue paying their premium and they let it lapse. Another reason is they get to the end of the term and they decide that it's too expensive to continue that policy. So they let it go. That's also kind of a continuation of outliving the term, but they choose to not pay the premium anymore. So it's not quite letting it lapse for the other reasons. With whole life, you're going to continue paying and you're going to get paid out. So what I tell people is you need a small whole life policy, unless you got that bread, and you need a bigger term policy. As a financial planner, one of the first things I do for my clients is review all of their insurances. It's the first place I can save people money. So I tell people at Wealth Our Way, our lowest level of service is $80 a month. And you do get people who are like, $80 a month? Oh my God, that's crazy. The first thing I do is go over people's finances. I look at their homeowners, their auto, their umbrella, their if they have business, their liability, their life insurance, and I try to find where I can save them $80. So now I don't have to hear their mouth ever again, because you got me for the rest of your life as your planner, and I saved you the $80 that you're paying me. I'm free. So most of the time I find in insurance is the quickest area to save them that money. When I see the travesties that I see why people don't like insurance salesmen and financial advisors, because you can very much end up feeling taken advantage of when somebody has, gotten you to the point where they told you one thing but sold you another thing. And a lot of times I see people with whole life policies because the premium is bigger, thus it paid a bigger commission, because I told you yesterday, Most agents get 50% of the premium as their commission, so they want to sell whole life. But I don't want to sell you a whole life policy that covers $250,000 of death benefit when you make $105,000 a year and we expect you to work for the next 30 years. You need $3 million of coverage. I did you a disservice by selling you a $250,000 whole life policy. I should have sold you a 20-year, $3 million term policy. We can get you a little teeny $10,000, $25,000 permanent policy so that when you pass away, when you're 80, 85, 90, nobody has to come out of pocket for your funeral. That's what insurance should do. It should make your loved ones provided for and not burdened. So I went way over. I just grabbed my phone. It was 12:54. I appreciate y'all tuning in and staying with me. I'm going to jump into Universal tomorrow. I know I throw a lot of information at you guys, and I invite you guys all, a lot of y'all are my peoples anyway, inbox me, call me, text me, go to the website. Any extra information of something that I touched on and I didn't go deep enough for you, let me know. I will cover it offline. I'm going to most likely keep this series going into next week because there is just a lot of information. But I'm here for you guys. I appreciate your time. Wealth Our Way. By all means, continue getting this financial knowledge. I'll talk to you later. Thanks for showing up.